Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker-dealer. This show is for informational purposes only concerning Market Chameleon tools and products. With that, D, are you ready to go?
Yep. Good morning, everyone. Thank you. Well, I'm going to share my screen. And as a note, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. We'll just keep an eye on it, and he'll let me know and read it back to me. Uh, if we don't get questions today, Will, I might just cut today's show a little bit short because, as I was telling you before the show, all of a sudden I got this terrible toothache. And unfortunately, my dentist went on a destination wedding away
Oh,
for like the next 10 days. So I'm like trying to find an alternative. So if we do have some questions, I'm going to try to answer them. If we don't, I might just cut it short. Um, a little
all
bit
right.
short today. Also,
So,
as a reminder, um, tomorrow at 2 p.m., we're going to have a webinar with Interactive Brokers. You have to register for that webinar. They're hosting it. It's free. But it's not going to be on YouTube like these shows. It will be on the Interactive Brokers platform, and we're going to talk about calendar spreads. So we're going to review calendar spreads, uh, and talk a little bit about, when when or why you would consider a calendar spread. We'll also look at ways a new tool that we have to screen for calendar spreads. So tomorrow we're going to be looking at uh, calendar spread, debit calendar spreads or long calendar spreads, where you're um, looking at owning the longer term option versus selling the shorter term option. So that's will be the focus on tomorrow's webinar. And you do have to register for it. And well, maybe if you have the link, you could put it out there and let people know. Um, and
the link is put in. Navigating,
okay,
scanning for all things calendar spreads. It's the title of
yeah,
it.
yep. And then let me to give you a couple minutes to put those questions in. We're going to take a look at this pre-market report that I have up, see what insights we could get from this report, and then we'll move on to our questions. So, pre-market report here, you will see this calendar view up top and some summary statistics of what happened in the pre-market hours on those dates. And this allows you to eyeball and look at today's activity versus the most recent history to see if you could spot something unusual going on or a trend. Let's review today's activity, September 9th. And here we see we have 589 stocks trading higher in the pre-market, 213 stocks trading lower. We have 207 million shares trading on up volume, 67 million shares trading on down volume. We have $4.3 billion worth of stock trading higher, $500 million worth of stock trading lower. So from that perspective, uh, it looks like trading in a pre-market hours has a bullish bias or bullish lean. Let me scroll down the page so we could get this more granular view of what's happening in the pre-market hours. So now what you see is stock symbols with price and price changes and volume in the pre-market trading. We also have our most active stocks, biggest percentage gainers and biggest percentage decliners in pre-market. And here I see 123 stocks made it onto our biggest percentage gainers list, 39 are biggest decliners. So from this perspective, it also indicates a more bullish bias in the pre-market trading activity. Now, stocks in the pre-market can trade with very low volume. very low liquidity. So we set thresholds for this for stocks to make it onto this list. If it meets our thresholds and makes it onto this list, it could include securities that are small cap stocks. It could be an ETF. It could even be a leveraged ETF or an inverse ETF that moves in the opposite direction, closed-end fund, preferred. So any security that's listed on the major US exchange. To narrow down this group of stocks, you can use the filters above. Now, we have this in my watch list filter over here. And this filter, it's unique because it allows you first to, if you create a watch list of stocks that you like to track, so your own unique watch list, you could use this filter to screen the report below by the stocks that you saved in that watch list. Okay, and you could do that in other parts of the website. We're going to use this in ETF filter in our example, and it's a similar concept. I'll show you how it works. When you click on it, you get this drop-down menu to select from, and here you see it's a list of different ETFs. We're going to go ahead and select SPY, which is that's that first ETF on the list. And now you'll notice that the list below got filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. So the idea is, well, if I save the watch list with S&P 500 stocks, and then I screened this out, now I narrowed down the group of stocks I'm analyzing to S&P 500 companies. And here you see 12 made it onto our biggest percentage gainers list, 1 on the decliners. So this also indicates that there's a bullish bias in the pre-market trading activity. And we gave it a couple minutes, so if you have a question, I'll take it now.
Nothing's popped up, D. Let me just confirm.
All
No.
right. All right, so let me navigate to one, I'll give it a couple more minutes. So I'll navigate to a screen right now just to start the conversation. Maybe we'll continue on it.
Could I share my screen real quick before you go to this screen?
Yeah, and it'll be a quick one,
Yeah, no, I get it. What screen are you going to?
So let me go to I'll go to the options chain. I'm gonna share my screen here. And let's use, I'm just gonna navigate to a stock. So let's just do it in a video because, it's popular stock right now, trading lots of options. And let's navigate here to the options chain. And as a options trader, a lot of times you'd go to the options chain to look at the markets and do some analysis, some ideas, get sense of where the markets are trading. So the options chain becomes a very important tool when you're trading options. It's where you're organizing all those options available to trade, number one, and then you can perform these analysis. So I'm going to come out here. Let's go to September 3rd expiration. So this is September 6th already expired. And now we're on September 3rd expiration. And over here on the left-hand side, you'll see these are all the option expirations that are available to trade in Nvda. Let me close this menu for a second to expand the screen. So you see all these different expirations. I just happened, to click on the next available expiration that didn't expire yet, which is September 3rd. And this is as of Friday's close. We're not open yet today. And then once I do that, I get this options chain with different options available. So you could get the different strikes, the calls on the left-hand side, puts on the right-hand side. And what I wanted to kind of quickly just introduce is that when we analyze the options, right? Now we have this options chain. We we want to try to analyze the options by first just kind of, eyeballing and spotting something that may be interested or unusual or something that's, something going on. And of course, we could do that by different ways. We could look at it from just the volume that's trading. So over here we have, you know, the different volumes in the calls, different volumes in the puts. And here it's it's obvious that it's very active. There's a volume in, almost every option on the board. And that's not always the case, but in case of Nvidia, it's very active. Lots of trading going on, and we see volume almost in every option. Like so far, maybe all the way up here, we don't see any volume. And another way, and of course, we could just like use some of these tools like most active call and put. So if I click on it, because it's not obvious we're the most active in this chain. So if I click on it, it says here the 110 and the 100 strike are most active. So probably looks like the most active calls on the 100 strike, 19. Oh, I'm sorry, maybe the put 98,000. So 98,000 contracts traded in the 100 put, and the 110 call looks like there's 87,000 contracts that traded there. So this is the most active call on the board. But besides looking at the volume, we could also look at how the options are priced relative to each other. And this can point to, different things. So for example, to look at how options are priced relative to each other, can use the Black-Scholes model, their option pricing model. And the option pricing model takes in the prices of the option and uses it as one of the inputs into the option pricing model, along with other inputs like where the stock price is, interest rates, dividends, so forth, and then comes up with this implied volatility. These are the implied volatilities of the bid and the offer, right? Because you have two different prices. So the bid is $4.50, for example. The offer is $4.60. Well, because you have two different prices, if you put it into the option pricing model, you're going to get two different results, right? So if you plug in 450, this scenario, we got that implied volatility is 59.7. If we plug in 460, we got the implied volatility of 61.3. And what this does is allow us to make relative comparisons of the different options on the board. Because really, it's hard to compare just the price alone because, yeah, you have 450, 460 for a 101 strike. But what does that mean for, $1 and 102 for 110 strike? So it's just eyeballing it. It's hard to compare the relative values of these options. So we have that Black-Scholes model to convert it to the implied volatility of that option. Now we can make a comparative analysis of which one is, priced higher or lower, according to the Black-Scholes model. Right? That's what we could even eyeball and see kind of like a skew where the implied volatilities are kind of moving lower, right, with these options. And looks like maybe at some point, they reach they actually start going higher, right? So this is a skew that kind of maybe looks like a smile almost, Um, so so that's one benefit of looking at the implied volatilities is that you could quickly get a sense of, the relative values of the options. But that's not the only thing that the implied volatility can do, is it could also point to certain places where there might be more competition in the option, or there might be for example, resting order sitting on the book. It's not a dealer quote, but it could be some resting order that may be an opportunity to uh, trade, for a better price, because the resting order, sometimes it betters the market, right? So if you have a market, here's one 1330 to 1345. Well, maybe somebody puts in a limit order, says, I want to sell it, but not at 1330, but I'm willing to sell it for less than $13.45. So you can put in a limit order. And if it doesn't trade, that will get posted, and that will become part of the new NBBO, National Best Bidder Offer. That's a firm quote. But that could also be an opportunity for somebody looking to buy that option, right? Because now all of a sudden there's a competition now to better the market. And to help us kind of try to detect those, right, we could use those analysis that we're talking about, including what the spread is of the market and what the uh, relative volatility is. So we call these IV leans, okay? So we look at the implied volatility leans, so you could see these implied vols that are colored, white is different than the ones in green, so they stand out. And this shows that there's perhaps an implied volatility lean. Now, it could be two reasons for that lean that I could think of. One is that it is a resting order on the limit order book, and a resting order or limit order, could just be put by anybody. It could be, somebody who entered in from their brokerage account, and it didn't trade, it got posted. It could also be a streaming order that improves the market with an implied volatility pump, but it will move with the market. So it will update. The order will cancel, replace, or update as the stock moves, because it's a derivative. So what it's trying to do is execute a certain implied volatility, but it will move with the market, because if the market moves up, for example, a call is worth more at the same implied volatility, right? Because now the stock is higher. If the stock moves down, well, the call value is worth less at the same implied volatility. So it could be an implied volatility lean, could be a resting order. We don't know for sure, just looking at this a snapshot of the market, but we could detect that maybe something is there. So here's one. Let's just take this one. This is a call option, 96 strike, and here we see that the call bid is 805 and the call ask is 815. And it's hard to tell here if anything is potentially going on just by looking at the calls, because the call prices are moving lower as the strikes go higher, which makes sense. But if we use the Black-Scholes model, we could see that something might be going on, because the offer on the 95 call, according to Black-Scholes model, implies a volatility of 67.3. So let's skip the 96 strike, and you can see all these strikes are very close together. If we go to the 97 strike, we see that the implied volatility of that ask is 66. So we do see, it's going trending lower, but look at the implied volatility in between. It's less than both the surrounding. So remember, we're making a comparative analysis and we're saying, well, why is that one in particular? If you have a smooth curve, right? If you have a smooth, if if you run a smooth curve through all these strikes, you would think it'd be somewhere between 67.3 and 66, but this is a little bit jaggedy. So same thing here in the call. Like, look at the call. Why is this particular call implied volatility bit below the 65.1 and the 63.8? So that, for whatever reason, that particular uh, call option looks like that there's a fade in both the bid and the offer, right? Maybe there's something there that, like a negative pump or so forth. And, we don't know exactly for sure, but that's an indication based on a relative analysis of the markets, right? That, well, what's going on here? Why is this one look so much different than the surrounding data, right? And that's another way that we could try to use the implied volatility in Black-Scholes model to help us kind of, narrow down on something, or to, spot something there that maybe something's going on. It's worth further investigation.
Hey D, that was great. I didn't want to interrupt you, but Rob asked as you were looking through the implied vols, is there a chart to see how implied volatility rises or falls on the options over a specific time period? He asked that as
Uh,
we're going through.
yeah, there is, but you know what? Can I?
Yeah, maybe we'll do that tomorrow. How about
Yeah,
that?
let's do it tomorrow because I just saw a phone call. Maybe it's a dentist that might be calling back. And
Let's hope. Let's hope, my
yeah.
friend.
So
All right,
let's.
everyone's wishing you good health with that tooth that's really bothering you, D.
Yep.
Dentists are can be scary, so be
Yeah.
careful, my friend.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see if I don't make it tomorrow morning. If I have to go to dentist, then we'll do it tomorrow afternoon at two
Yeah,
o'clock.
remember everyone, we have the IBKR webinar. There's a link in the chat. Put tomorrow, you have to register on their site. Don't have to watch it live at 2, but they'll send you access to the recording. There's also a large library of interactive broker webinars you can get on their site that we've done. I think this will be like the 34th. Everyone have a great day.